We're putting on a 25% tariff without exception.
That 25% tariff is an existential threat.
If America is importing more than it's exporting, China is exporting more than it's importing. What's the impact of this pattern? Take a look at what happens and you see GDP in America remains constant while GDP in China grows. And you can see the difference in the growth rates. China's economy growing, the American economy flatlining.
US tariffs against China add up to 145%.
Apple shares posting their worst month in more than 2 years.
America's biggest technology companies lost some $750 billion in all.
Even Tesla, it turns out, doesn't like tariffs.
Trump's tariffs, they're going to cause chaos, okay? And that's obvious already in the volatility of stock markets and so on. Most people are focused upon the formula that to calculate those reciprocal tariffs, which I have to agree is crazy. It doesn't make any sense.
The influential contrarian economist Steve Keen.
Brilliant economist that criticizes much of modern economics.
The research fellow at the Institute for Strategy, Resilience and Security at University College in London.
He is someone that each and every one of us has to listen to, whether we agree or disagree.
Here's Steve Keen.
The biggest economic news of the last few weeks has been the introduction of enormous tariffs by the Trump administration. And most people are focused upon the formula that to calculate those reciprocal tariffs, which I have to agree is crazy. It doesn't make any sense. However, the reason this is being done does make sense, and I want to focus upon the reason rather than the current method the American government is using to try to achieve this particular end. And one of the opening statement in this explanation of why the tariffs were brought in is that they're calculated as the level of tariffs that's necessary to eliminate bilateral trade deficits. So the objective of this proposal throughout has been to get rid of the trade deficit. Now, the argument, a lot of people are saying that's a bad idea. Modern monetary theory, for example, will argue that exports are a cost and imports are a benefit. So if you're running a trade deficit, you're sending over pieces of your paper to another country, they're sending you back manufactured goods. You're coming out ahead. That's the sort of argument they use. Equally, a lot of economists are in favour of free trade because they say, well, free trade is the best possible situation. And when you ask them about trade deficits, the argument used to be that, that'll be eliminated by movements in the exchange rate. So a country running a trade surplus will see its currency appreciate, that'll get rid of the surplus. A country running a deficit, it'll depreciate, that'll get rid of the surplus. As Steve Moran says here, who's the chief economist advising Trump, he says that simply hasn't happened. He's quite right. Okay? On the financial side, the reserve function of the dollar is called persistent currency distortions. What he's arguing there, quite correctly, is that because the American dollar is used for international trade, countries need the American dollar not just to buy American goods, but to buy goods from any other country at all. Now that gives an enormous buying pressure to buy the dollar to enable trade to take place. That overvalues the dollar, and that makes American manufacturing less competitive. So that's what they're trying to get rid of. Now, I want to show that that is actually a good idea. Whether or not this proposal will do it is another story, but the idea of getting rid of the trade deficit is a good idea because a trade deficit destroys money that has been created either by the government or the private sector in the country running the trade deficit. Well, let's just take a look at that in double entry bookkeeping terms, because to understand what happens in finances, financial transactions, if you don't do it in double entry bookkeeping, you simply don't understand it. You might be right, you're most likely going to be wrong. So you have to be able to see it from double entry. And that's what my software package Ravel enables. It's the only program in existence that lets you model financial transactions using double entry bookkeeping. So what I'm showing here is a very simple view of American banks and looking at the financial transaction of consumption, wages, government spending, taxation, exports and imports. Now, if you have an American company selling to an American consumer, that shuffles who has the money. The money goes from the consumer's account to the firm's, so there's no increase in the amount of money. Equally, an American firm paying wages to an American household reduces the money in the firm's account and increases the amount of money in the household's account. So those transactions don't change the amount of money in existence. So how do you create money? This is a question which has been completely ignored in the discussion, or gotten wrong by most of the commentators who've spoken about it. Think about what money is these days. You have some coins in your pockets, okay, some notes and coins, but fundamentally your money supply is the amount of money in your bank account. So bank accounts are the fundamental form of money these days. So if you want to create money, you've got to increase bank accounts. Now, how do you do that? Well, you don't do it by a transaction that goes from one bank account to another. That shuffles money around. It doesn't actually create money. What you need is something that boosts one account on the liability side for the bank or the bank's own equity, also boosts an asset on the other side of the bank's ledger. So to make bank deposits increase, there must be something which increases the liability that a bank account is for the bank and also increases an asset for the bank at the same time. Now, if you look at government spending, government spends by putting money in your bank account. That should be obvious. Okay. What's the balancing item? It also increases the amount in reserves. And what actually goes on when you have the government spending money, let's say the government wants to buy a nuclear reactor off Westinghouse. It credits the reserve account of the bank with which Westinghouse banks, gives $1 billion, and tells the bank to put that $1 billion in Westinghouse's account. So to actually create government spending, you must also create reserves. So government spending causes the bank liabilities to rise, it causes bank assets to rise, and that creates money. So government spending creates money. Equally, taxation works in the opposite direction. If the government puts its hands into your proverbial pocket, your bank account, to take tax out, your deposit account falls and reserves also fall. And those reserves go down, and then the central bank, that increases what's called the Consolidated Revenue Fund for the Treasury at that operation. So government spending creates money, taxation destroys it. Now, what about exports and imports? Well, if Westinghouse exports a nuclear reactor to China, let's say, then that means that the Chinese company or government that's buying it ultimately buys the American dollars necessary to put those dollars inside Westinghouse's account. That creates money for Westinghouse. It also increases reserves. What about imports? If you have American consumers buying BVD cars, then their bank accounts go down. That also causes the reserve assets to go down. So government spending creates money and exports create money. Government taxation destroys money and imports destroy money. So what happens when you have a government running a so-called deficit, so a government is spending more than it takes back in taxation? That actually, on its own, that creates money and enables the economy to grow. Okay? I'll get into the debt arguments at a later stage, but in this particular case, the straightforward result of the government spending more than it gets back in taxation is to create money, and that enables economic activity to expand over time. But at the same time, with the country's running a deficit, what if the deficit on trade equals the deficit of government spending? What actually happens? And with Ravel, you can illustrate that. So this is a model where a very simple model, but I've made a model of banks in America and banks in China, and I have them both doing the same operations: consumption, domestic wages, government spending, government taxation, the exports and imports. And of course, the exports of the United States are the imports of China and vice versa in this extremely simple model. But the basic points remain even when I make it much more complicated and include all the bond sales and everything else that has to take place. So I have money being the sum of what's in the firms and the household accounts. That turns over a couple of times a year to generate GDP. Part of that goes to workers as wages, and that enables households to consume. And then I have the government deciding to spend a certain fraction of GDP, tax another fraction. If there's a difference between the two, that creates a deficit. That's government deficit. And then equally with exports, if the country is exporting a certain fraction of GDP and importing, the gap between the two is the trade surplus. If exports are greater than imports, trade deficit, it's the other way around. So I now want to see how these interact. And I'll just go across to the publication stage of this model. So if I start with government spending in China and United States, both being equal to taxation, and exports equal to imports in both countries, and run the model, hang on a second, what have I got wrong there? Aha, let's stop that. And I had imports being larger in America. Okay, let's start. Now, so with the exports equal to imports and government spending equal to taxation, no money is being created and both GDPs flatline. What happens if we start instead with both countries spending more than they get back in taxation, but exports still balanced? On that case, you get both economies growing at the same rate. The deficit actually creates money that enables spending to occur, enables economic activity to expand, and you can see that with the top left-hand graph there. Now, what happens instead if you also have the American economy running a trade deficit? This is a reciprocal model. So if America is importing more than it's exporting, China is exporting more than it's importing. What's the impact of this pattern? So here I have both countries running a 1% of GDP, a government deficit, which creates money in both countries, but one of those countries is also running a trade deficit, which destroys 1% of money, and it's transferring money creation across to the other economy. Take a look at what happens, and you see GDP in America remains constant, while GDP in China grows. And you can see the difference in the growth rates. China's economy growing, the American economy flatlining. Now, if we have, say, a 3% of GDP deficit in both countries, you get a higher rate of growth. Okay, so it's good looking good, they're both growing. What if America's trade deficit is also 3% of GDP? Again, it flatlines. So a trade deficit creates money for the other country. And if the government's running a deficit, which creates money and enables economic activity to occur, that economic activity can be transferred to another country. And that's what Trump is complaining about. That's what Steve Moran is arguing here. In monetary terms, it makes eminent sense. If you want to hang on to the stimulating effect of running a government deficit and creating money for your own economy, then you have to have balanced trade. So we need a way to bring about balanced trade. Now, Trump's tariffs, they're going to cause chaos, okay? And that's obvious already in the volatility of stock markets and so on. There's an appraisal from another person that you would never associate with Donald Trump that nonetheless achieves what Trump is trying to achieve here. And that's a proposal for John Maynard Keynes for what he called a bancor, an international currency that would be used for trade rather than using a domestic currency. I'll talk about that in another video.
If you're like many other truth seekers and want to learn 50 years of real economics from me in only 7 weeks, you'll love my new 7-week Rebel Economist Challenge as well. To apply, go to apply.stevekeinfree.com. If you qualify, you can attend my lectures, ask me questions personally every week, and make friends with a great group of like-minded people. So again, like many others, go to apply.stevekeinfree.com to apply as well for the 7-week Rebel Economist Challenge. Good luck.